Hi everyone, it's PK here. I just wanted to talk today about cash flow versus capital growth. There was a post that I did this week that said capital growth is the engine and cash flow is the oil. Capital growth is the engine and cash flow is the oil. And that post got a lot of responses, and I got a lot of messages in my inbox after that as well. And just wanted to qualify that a little bit because sometimes new investors, we can get into a false belief that cash flow itself is going to accelerate our wealth. And that's not untrue, but you have to look at the facts that say, let's say you find a property, let's say it's $400,000 and it has 5 to 6% yield, which is actually a really terrific yield. You're not going to get that sort of yield in most parts of, Brisbane, Sydney, or Melbourne. You can get it in parts of Adelaide, parts of Brisbane, but it's very rare. Even at 5 to 6% yield, the cash flow after all outgoings, after your interest payments, even though we're paying interest these days at around 3.5%, so the lowest ever, even despite that, if you add all the council rates, let's call it $1,000 to $1,500 a year on maintenance, property management fees, all of the outgoings, even a 5 to 6% yield only generates less than $3,000 of passive cash flow or positive cash flow a year. And I'm assuming the most the most stretched LVR of around 90%, right? If you have a less of a LVR, you may get more cash flow, right? But the fact is that you want to be able to use the bank's money to purchase more and more property, because capital growth is what accelerates your wealth. So making $3,000, $2,000, $4,000 a year from a high yielding property is good. There's nothing wrong with it. But how many of those do you need to replace your income, right? Even at $5,000, you'll need 20 properties to generate $100,000 a year passive income. Now, 20 properties in this day and age with the current lending environment is very, very difficult, right? This is not 20 years ago. So I just wanted to put some of those facts out there, and happy for it to be debated as well. But, let's say an average property, even very conservatively, achieves 3% capital growth. 3% capital growth. This is very, very, very conservative, right? And let's say the property is worth $500,000. So 3% is 3 times 5, it's $15,000 of capital growth every year. $15,000 is a very conservative number, and you can see how that just completely eclipses the positive cash flow of around $3,000 every year, right? So let's say you purchase a property that achieves just $3,000 of positive cash flow. Great. After 10 years, that's $30,000 that property has produced for you without you having not done much. But if it achieves just 3% capital growth, right? Just 3% capital growth, that's more than $100,000 of capital growth over 10 years. In fact, that's more than $200,000 of capital growth over 10 years, and that's very, very conservative. Capital growth over the long term is between 5 and 9%, depending where you invest, okay? So I just wanted to put those facts out there. You do need cash flow to hold a property. You don't want to be paying $20,000, $30,000 a year to hold a property. For most people, that is. But just remember, it's the capital growth that accelerates your wealth. It's not the cash flow. You need to be mindful of cash flow to hold a property, but the longer you can hold a property, the longer it has to achieve capital growth and the more returns it can generate for you. Okay, so